Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your Market Compass weekly recap for Friday, March 20th, 2026. This was decisively a negative week for U.S. stocks. The Dow closed at 45,577, down about 981 points for the week, a loss of just over 2.1%. The Nasdaq finished at 21,647, down roughly 2%. The S&P 500 closed at 6,506, lower by about 1.9%. And the Russell 2000 closed at 2,438, or down about 1.7% for the week. And small caps matter here because the Russell 2000 also moved into correction territory, a sign that weakness is extending beyond the biggest names in the market. Now, looking at Friday alone, the tone stayed weak right into the close. The Dow fell another 444 points. The Nasdaq dropped just over 2%. The S&P lost about 1.5%, and the Russell 2000 fell more than 2.2% on the day. This was not just one ugly session. This was a week where pressure built day after day. Markets began the week relatively stable, but selling intensified as the week went on. And by today, the tape clearly reflected a market losing momentum. The 5-day trend tells the story. Lower highs, lower lows, and very little sustained buying interest. And there was a macro driver behind it. Oil surged as geopolitical tensions intensified, and that pushed inflation concerns back to the center of the market conversation. When oil rises sharply, investors immediately start thinking about transportation costs, production costs, and the broader inflation picture. That also affects Fed expectations. The market is increasingly trading as though rate cuts may stay off the table longer than investors had hoped. That is what made this week feel heavier than a routine pullback. This was not just technical weakness. This was a repricing around inflation risk, energy pressure, and tighter for longer rate expectation. So what am I watching next week? First, I want to see whether buyers step in early or whether this selling pressure continues. Markets often try to stabilize after a week like this, but real stabilization has to show up in both price and participation. Second, I'm watching breadth. If the Russell 2000 is already in correction territory, that tells us that this is not just a large cap issue. The market needs broader participation, not just a handful of names trying to hold on to the indexes together. Third, I'm watching rates. If oil stays elevated and Treasury yields remain firm, stocks may continue trading under the assumption that the Fed stays sidelined longer than many expected. Now, let me say a word to investors with low risk tolerance. And this is important for you to hear. If you're a conservative investor, this is where discipline matters most. Weeks like this can feel unsettling, but this is exactly why your portfolio should be built around your actual risk tolerance and not around headlines or hype. For lower risk investors, the focus right now is not chasing a rebound. It's making sure your allocation reflects your need for stability, liquidity, income, and downside protection. Cash reserves matter. Quality matters. Diversification matters. And if a week like this feels more stressful than it should, that may be a signal to review whether your portfolio is carrying more risk than it was designed to carry. This week was a reminder that narrow leadership can only carry a market so far. When oil rises, rate cut hopes fade, and small caps roll into correction territory. The message is simple. This market wants stronger fundamentals before it can move sustainably higher. Do not confuse movement with direction. Stay focused on your plan, not the noise. Stay oriented, my friends, and elevate your legacy.